and transparency. Fifth, provides disclosures even if not required by any statute. Statute means government, law. Okay, so now let us understand the advantages first. Advantages of accounting standard are: it standardizes diverse accounting policies and practices. There are innumerable number of policies and practices in accounts. So accounting standard helps in standardizing, giving a standard direction. Okay, now are you all understanding what accounting standards does? It gives a direction, a standard direction for diverse accounting policies and practices. This is the way to read it, but how to write it in exam, it is this manner. Okay, it eliminates to a great extent non-comparability. Okay, so what does this means? It enhances comparability between two financial statements. It means it enhances comparability between two financial statements of different entities. Okay, so it is written in a reverse manner. It eliminates to a great extent non-comparability. It adds reliability to financial statement, develops consistency and transparency. This is self-explanatory. Provides disclosure even if not required by any statute. Statute simply means government or law. Accounting standard says, what are the advantages of accounting standard? It says it provides disclosure even if not required by any statute. What does disclosure means? Disclosure is a word that you all are coming first time across. Disclosure means after solving everything we write in notes what we have solved. So disclosure is something like what we have done in a financial statement. If we have increased any, if we have revalued any of our assets, so in the disclosure we'll write we have revalued the asset as per the market value. So disclosure means telling the person who is reading the financial statement for its better understanding why such changes were done, why revaluation of the assets were done. So disclosure is something that I hope you all are understanding that. Now we'll move on to disadvantages. Disad first, accounting standards does not covers every transactions every transaction and events. Second, accounting standards are not flexible. Third, accounting standard cannot overwrite the statute. Accounting standard itself provides multiple choices which affects comparability. See, disadvantages. What does disadvantages of accounting standards are? Accounting standard does not covers every transaction and event. It is not possible for the person who have framed the accounting standard that he has covered all the transaction and event while framing such accounting standard or such policies. So disadvantages are accounting standard does not cover every transaction and event. Accounting standard are not flexible. They are rigid. We have to specifically follow the direction that accounting standard gives us. Accounting standards cannot override the statute. What the statute means, you know. Accounting standard cannot write a negative statement that will override the statute. If the statute say, that is the government or law say illegality is something that cannot be shown in the books of account, accounting standard cannot say illegality. Even if it is illegal, we have to show. It is something like that. I hope you all have understood what was the example of. Accounting standard cannot override the statute. Accounting standard itself provide multiple choices which affects comparability. Hope you have understood I'll give you the reason behind this disadvantage, because what does this means is, while valuing the depreciation, we have 2 to 3 methods, that is WDV method and SLM method, that is written down value method and straight line method. We can choose either of the method. So if entity A and entity B is there, if entity A is using SLM method and entity B is using WDV method, it will be difficult for comparing, it will become less comparable. Okay, are you all understanding? So accounting standard has this limitation. So firstly, I want you all to please copy this much, the disadvantages and advantages of accounting standard. I hope you all have copied this much. Now we'll see the types of entities. Types of types of entities. My phone was ringing, sorry. Types of entities. There are 3 types of entities. Level 1 entity. What is level 1 entity? What does level 1 entity means? Level 1 entity means which have securities listed or in process of listing within or outside India on a stock exchange. Second, what are level 1 entities? Level 1 entities are banks, financial institution, and insurance companies. See, how I am telling is what are level 1 entities. So I want you all to write it, what are level 1 entities: banks, financial institution, and insurance companies. Then what is the turnover of level 1 entity? The turnover of level 1 entity is more than 50 crore, that is CR, 50 CR. How much public borrowing can level 1 entity do? Public borrowing more than 10 crores, then only it will be level 1 entity. 5. Who are level 1 entities? Level 1 entities are holding and subsidiary company of the level 1 entity is the level 1 entity. I know this is very unpleasant to hear. Holding and subsidiary company of the level 1 company is a level 1 company. This is the theory. This theory is not given somewhere properly, so I have given in writing, and now I'll give level 2 entity. Then level 1 and level 2 entity will compare, and then we'll move on to level 3 entity. Level 3 entity is very small. Level 2 entity, just wait a second. Okay. 1. Level 2 entity is one which is not a level 1 entity firstly. Second, level 1 entity is one whose turnover is less than 50 CR but more than 40 CR. Hope this is clear to you all. Public borrowing is less than 10 CR but more than 1 CR, and again the same. Holding an subsidiary company of the level 2 entity is the level 2 entity. So now we'll completely read this because level 3 entity is very small and it will complete in a second. First we need to understand what is level 1 and level 2.